What are the prospects for stocks? Boom or bust? Lights, camera, action. Buckle up, folks, because today we're embarking on a thrilling roller coaster ride through the mesmerizing world of the stock market. Imagine a place where fortunes are made and dreams are shattered in the blink of an eye, where the heartbeat of the global economy pulsates through tickers and charts. Whether you're a Wall Street hotshot, a savvy entrepreneur, or someone who just opened their first trading account, this place has a seat with your name on it. From the adrenaline-fueled trading floors to the mysterious algorithms that silently weave their magic, the stock market is like a blockbuster movie where you are both the audience and the protagonist. In this episode, we're digging into the tantalizing question: what are the prospects for stocks? Boom or bust? Get ready to uncover secrets, decode mysteries, and to maybe even find the treasure map for your fortune. This is the gold rush of the 21st century, and trust us, you don't want to miss a single second. First, let's get our fundamentals right. The stock market is like a gigantic global auction house where ownership of companies is bought and sold. It's a place driven by supply and demand, emotions, global events, economic indicators, and so much more. When you buy a stock, you're buying a piece of ownership in a company, and your fortunes rise and fall with the performance of your chosen company. Now, let's talk about market cycles. The stock market goes through cycles known as bull and bear markets. A bull market is when the economy is doing well, employment rates are high, and stocks are generally going up. Conversely, a bear market is when the economy slows down, unemployment rates rise, and stock prices drop. These cycles have been observed since the inception of stock markets and are as natural as the ebb and flow of the tides. Historically, the stock market has experienced more bull markets than bear markets. Since World War II, the average bull market period lasted approximately 9 years, while the average bear market lasted about 1.4 years. But here's the catch: timing the market is nearly impossible. As renowned economist John Kenneth Galbraith once said, "The only function of economic forecasting is to make astrology look respectable." On to the next point, let's talk about market indicators. There are leading and lagging indicators. Leading indicators, such as stock prices and the number of new companies, give us insights into how the economy will perform in the future. Lagging indicators, like unemployment, tell us how the economy performed in the past. Investors use a combination of these indicators to make predictions. But remember, predictions are not certainties. Now, let's focus on an interesting phenomenon: the role of technology. Technological advancements have been a driving force behind many stock market booms. The dot-com boom of the late 1990s, which was driven by the rise of internet companies, is one example. In recent times, we have seen companies in artificial intelligence, electric vehicles, renewable energy, and biotechnology driving growth. These industries hold the promise of revolutionizing the world and hence attract significant investments. Global events are another major influencer. Take, for instance, the COVID-19 pandemic. It caused an initial crash in stock markets around the world. However, it was followed by a surprisingly quick recovery, leading to what many called a K-shaped recovery. Technology and healthcare stocks in particular soared as work from home became a norm and the race for vaccines intensified. Dovetailing from global events, international politics and government policies play a significant role. Trade policies, tax reforms, geopolitical tensions, and international relations all have a direct impact on the stock markets. For instance, the trade war between the US and China in the late 2010s had ripple effects across the global market. One must also not forget about corporate earnings. As an investor, it's important to pay attention to the financial health of the companies you're invested in. Positive earnings reports can lead to stock prices rising, while negative reports can have the opposite effect. Furthermore, behavioral economics is a fascinating aspect of stock market movements. This subfield studies how psychological factors affect economic decisions. Fear and greed are two primary emotions that drive the market. When investors get greedy, they can create bubbles, and when they get fearful, they can create crashes. Now, let's talk about interest rates. They're like the temperature gauge of the economy. When the economy is hot, central banks raise interest rates to keep it from overheating. When it's cold, they lower them to encourage borrowing and investing. Generally, low interest rates are good for stocks, especially for companies that borrow a lot of money to grow. Another factor is inflation. It's a double-edged sword. Moderate inflation is often seen as a sign of a healthy economy and can be good for stocks. However, high inflation can erode purchasing power and lead to central banks raising interest rates, which can be negative for stocks. It's also important to look at global economic growth. In a globalized world, the fortunes of countries are interlinked. Strong global economic growth is likely to be conducive to a booming stock market, where a global downturn can lead to a bust. Finally, let's address diversification. It's crucial not to put all your eggs in one basket. By spreading investments across different types of assets, sectors, and geographical regions, you can mitigate the risks of a bust in any one area. Let's now get our magnifying glasses out and examine some lesser-known but surprisingly influential factors that can affect stock markets. And in the process, we might just pick up a trivia or two. How about the weather? Yes, you heard it right. Studies have shown that there's a correlation between stock market returns and the weather. Sunny days tend to see higher stock returns compared to cloudy days. This phenomenon, termed as the weather effect, suggests that mood plays a role in investment decisions. Speaking of moods, social media has become a force to reckon with. In recent times, communities on platforms like Reddit have demonstrated their ability to move markets. The GameStop saga is a classic example, where an army of retail investors rallied behind a stock, causing a massive short squeeze. The power of the crowd, it seems, can sometimes outmuscle Wall Street giants. Delving into history, have you ever heard of the presidential cycle? This theory suggests that the stock market's performance can be linked to the 4-year presidential term in the US. Historically, the first 2 years of a presidential term have seen lower returns on the stock market compared to the last two. This might be because presidents often implement less popular economic policies early on, and then introduce stimulus measures as re-election approaches. Next, let's talk about superstitions, specifically the January effect. Some investors believe that the performance of the stock market in January can predict its performance for the rest of the year. Though not foolproof, this belief still influences investment decisions for some. Another quirky one is the Super Bowl indicator. This whimsical theory suggests that if a team from the National Football Conference wins the Super Bowl, the stock market will have a bullish year. If the team from the American Football Conference wins, expect a bearish year. Although this has no basis in finance, it's a fun theory that gets tossed around during Super Bowl season. Lastly, let's touch upon space, the final frontier. The burgeoning space industry is not just about exploring the stars, it's also about satellite technologies, space tourism, and potential asteroid mining. These ventures could unlock unprecedented opportunities. Investing in companies that are at the forefront of space innovation might just be akin to buying a lottery ticket to the future. As we put away our magnifying glasses, let's take a moment to appreciate the sheer complexity and dynamism of the stock market. It's an entity shaped by numbers, yes, but also by human aspirations, emotions, weather, social trends, historical cycles, and maybe even touchdowns and field goals. While discerning the patterns may feel akin to reading tea leaves, staying educated, diversified, and vigilant can pave the way for informed decisions. Whether it's boom or bust, the stock market is an adventure where the journey is as enlightening as the destination. The wise investor sails these waters with a compass of knowledge, an anchor of prudence, and an insatiable curiosity for the winds that blow. To wrap things up, the prospects for stocks can be influenced by an intricate web of factors including market cycles, economic indicators, technological advancements, global events, corporate earnings, psychology, interest rates, inflation, and global economic growth. While the allure of the stock market is undeniable, it's also a realm where fortunes can be made or lost swiftly. It's important to approach investing with a keen eye, an open mind, and a grounded understanding of the forces at play. Remember, investing is not just a science, it's also an art.